You talk to entrepreneurs from every industry, and the common theme is that the restaurant industry is one of the most difficult industries for you to be successful in. Long hours, low margins, it's hard to keep repeat customers, and most restaurants actually they go out of business within a year. And then there's Jersey Mike's. Jersey Mike's, as we're seeing on screen right here, they have had an amazing run for the past 20 years, matter of fact. They've been open for 70 years. They're preparing for an IPO. After 70 years, they're preparing for an IPO. And it's not like they've not had success. So we're talking about 20 years of same store revenues increasing. We are mentioning that they were bought last year by BlackRock, I believe, for $6.3 billion, preparing for an IPO at about $7.6 billion, currently at 3,300 locations, looking to increase that to about 7,500 locations in America, already in all 50 states. They are primarily owned by franchisees, and over 90% of their coming stores or locations are going to be owned by franchisees, which is a major point for your business going forward. And their aim is to hit 15,000 locations on an international scale as they IPO. Today, we're not going to talk about the IPO of Jersey Mike's, which is quite phenomenal if you ask me. We're going to look at it from an entrepreneur's perspective and learn valuable lessons that help you and I, as entrepreneurs, run more successful businesses and learn a new way that we can make our business grow and become successful by looking at Jersey Mike's success. If you're new here, my name is Jabez Roberts. I have been an entrepreneur for the past 11 years, primarily in the web development and digital marketing space, a little bit of software engineering, and I'm currently a double major in accounting and banking and finance. Now, let's get started. The first lesson that we are learning from Jersey Mike's amazing IPO's news is that businesses don't go public because they need money. They go public because they have a proven machine with repeatable success. Now, looking at the numbers again, 20 years of their 70 years of existence, each store location has had increase in revenues. Now, if we take a look at the article right here, I'm just going to point out some of the numbers. It says here, Jersey Mike's has enjoyed 20 consecutive years of same store sales growth, which is a better way to say this. In 2025, same store sales rose 3.2%. That was last year. The year before, it rose 2%. And in 2023, it was 8.4%, which is absolutely stunning for a restaurant. For your business, before you think about an IPO, think about providing a solid foundation and creating a system that is proven for success, because the IPO is only going to amplify what's already there. So if you have chaos, it's going to maximize your chaos. And Jersey Mike's and Jersey Mike's knows something about this that we're going to learn a little bit later in the episode, where they understand that to go from 1 to 100 locations, you need a different system to go from 100 to 3,000 and from 3,000 to 15,000, which is their goal. Let's take a look at the second lesson real quick. Oh, and by the way, this video is brought to you by Perugi Partners, financial company I started to help entrepreneurs and business operators make better and more informed financially sound business decisions built on clearer books, up-to-date numbers, and ongoing financial assistance in your business. Perugi Partners are come for more, but let's dive right into lesson from Jersey Mike's that's going to help you make more money as an entrepreneur. The second lesson is that one of the most important numbers that you need to look at not only in your restaurant but in your business is what's called lifetime value. The lifetime value of your customer is literally telling you how much money do you normally earn from a customer for the duration of their time supporting your business. So let's say they normally stay in your business for 2 years. They normally spend about $17,000 per year. That means they have a lifetime value of $34,000. They might be a construction client or HVAC or whatever the case might be. This helps you to understand how much you can spend to get a new customers. A lot of businesses have gone out of business simply because they don't know their lifetime value and their customer acquisition cost. The reason why this is important with Jersey Mike's is because the same store sales growth tells us something. It's not just a vanity metric that you throw out there and it's not important. It's extremely important. The story behind Jersey Mike's same store sales increasing year on year for the past 20 years is literally saying to us that whenever someone goes to Jersey Mike's, they don't leave, they keep going back. And As someone who's worked in the restaurant industry before, that tells me two things. They have really good food and really good customer service. If that is not the case, then somewhere along the line, the same store sales are not going to be good. You need to have both of those along with good prices and so on. But especially good food, so good quality food and excellent customer service. Otherwise, you'll be failing. The third lesson from Jersey Mike's IPO that we're looking at is that for the new location, over 90% of these locations, or more or less 90% of these locations, are going to be opened by existing franchisees. This is an important metric. I'm going to tell you why. As an entrepreneur, as a business owner, you know the ins and outs of your business. Your employees know the ins and outs of your business in a way that someone reading a spreadsheet, looking at the balance sheet, someone who's looking at the business from the outside in, don't know, they don't understand. As a matter of fact, one more step forward is if your business, especially in a restaurant space, we read about this in Peter Lynch's One Up on Wall Street, where he invested in this local restaurant that he loved eating from. They made good food, real nice customer service. They were moving to a new location and it failed. As you grow your business, you cannot assume that because you've been successful here in this specific location and in these specific conditions, that expanding to a new location with new conditions means you're going to be successful. You just don't know. But if franchisees are 90% of the applicants or the persons that are going to be buying these new locations, because remember, currently 3,300 locations, their aim is to get to 7,500 in America. They're already in all 50 states, but they feel they're underpenetrated. And globally, they're going to get to about 15,000. That's the goal. If 90% of these are going to be filled by current franchisees, let's say just in America, those within the business who have insight about the business have a certain level of confidence in the business and its ability to continue growing. Let's take a look at it here. It says that not surprisingly, the almost entirely franchised 3,300 unit chain appears to be doing quite well. One of the numbers about this IPO though that stuck out before we move on to the next lesson, it says here that the average unit volume, was nearly 1.4 million last year, but the company said about 6% of units achieved the average unit value of $2 million or higher. And quite interestingly is the highest unit value that I've seen in the restaurant industry with a quick Google search told me that it was Chick-fil-A, I believe, 7.6 million. McDonald's was over 6 million. And perhaps In-N-Out Burger was up there at about 5 million. I don't remember the list exactly. On the surface of things, this doesn't look quite impressive compared to 7 and 5 and 6 million. But if you understand that Jersey Mike's, which is important for you to understand as an entrepreneur, the nature of Jersey Mike's business and your target market is a little bit different than the McDonald's of the world, the Chick-fil-A's of the world, the In-N-Outs of the world, the Five Guys of the world. And that's simply because they're a little bit closer to Subway in that they offer sandwiches, delis, and those types of healthy food, as you would put it. And the reason why this is important is because Subway, they might not have had a very high average unit volume. And the reason is because they cannibalize their own franchisees, right? They have so many locations that franchisees started being cannibalized by other franchisees. So that's not a very big number that pops out at me when you look at it from the context of the industry. But when you look at it in context for the niche that they're in and their target market and what their competitors have done and they failed at, I think this is an excellent number to look at, which is going to bring us to, I think we're at the fourth point or the fourth lesson to learn from Jersey Mike's IPO. The fourth lesson from Jersey Mike's IPO is that they aren't expanding because they hope it works. They're expanding because they know it works. No, like we said, this is a lesson in a game of patience. They've been in operation for 70 years. Coincidentally, I think their founder is still there. He's the chairman after the buyout from BlackRock last year. But anyway, they've been in operation for 70 years. Of those 70 years, for the past 20 years, they have had consistently increasing same store sales revenues going up, which, especially in the restaurant industry, is unheard of. It's a very choppy industry. They know what they're doing. And I think that this is the main reason why BlackRock went and spent $6.3 billion just to purchase them last year. And within a year, they're looking for an additional, let's see, 1/6, that's about 12%. They're looking for 7.6 billion. So that's about 12% if I'm doing the math correctly. That's an amazing return on investment early on. And that tells you something. When you're doing your IPO, do not do what tech companies do. Do not base your value or think that the value of your IPO is going to be based on hype and not on numbers. And this is going to lead into another excellent lesson that we're going to look at in a short few minutes. Your business needs to have a solid foundation with systems and with numbers that proves it can scale and it can meet market demands. And yet again, those same store sales growth, and I also like to look at the average unit volume, is quite important here because these are like proof in the pudding. This is not a concept that they're hoping is going to work. This is them saying that this is what we have done under similar conditions before, which in terms of risks and return on investment, this is actually very important. This is very special. And as for you as an entrepreneur and even as an investor, you want to have a business that generates cash flow, not hype, which actually, let's go right into the fifth lesson because it's tied directly to that. The fifth amazing lesson from this IPO of Jersey Mike is that BlackRock bought them because they're not buying sandwiches, they're buying predictable cash flow. In your business, cash flow trumps all. They always say cash is king, and there's a reason for that. You cannot go to the bank with hype. Well, you can for an instance, but it's not going to be very helpful for you. In this case, Jersey Mike's is cash flow positive. They're profitable as it seems. They did make some losses. So let's take a look at those numbers before we dive right into these next few lessons. It says that the first quarter revenues totaled $122 million, and that's a 10% increase from last year, which is beautiful, right? So they're increasing revenues, but they had a net loss of 24 million. But this 24 million in net loss compared to their net income of 10 million for the prior year was blamed largely on the 28 million buyout of area directors. And we're going to look at that point in the next 3 points, I believe. The reason why this is all important is because even though they're making a loss, they're still in a very strong financial position. Because if they've only lost 28 million because of area directors buyout, and this is tied to their growth strategy, in my opinion, as well. So we're probably going to have to look at that next. They've lost only 24 million, but the buyout was 28 million on 122 million of revenue for the first quarter only. And that's a 10% increase. They have very strong cash flow. And in the game of investing, in the game of entrepreneurship, especially, do not get over enamored or in love with debt. Always take a look at your cash flow. This gives me an opportunity to tell you about my company, Perugi Partners. If you are struggling to make payroll, but your company is profitable, and that is possible, or you're growing, but you risk going out of business because you have cash flow constraints, go ahead and take a look at my company, perugipartners.com. We help businesses make better financially informed decisions by helping you have clear, up to date, and easy to understand financials. We keep an eye on your finances, your cash flow, your payables and receivables, your expenses, and your income to ensure that you never have a cash shortfall, all your invoices are paid on time, and you don't have any outstanding invoices from clients that are not paid, which could help your business grow. perugipartners.com/get started to book a consultation with us and see how best we can help you. Back to the episode. It mentions here the buyout of area directors, which is the sixth point. So they're buying out their area directors. And the way this is going to work is that they're going to transition them. It says right here, they're going to transition to regional vice president model. Now, I don't know the term exactly, but after looking into it some more, it says here that I move away from area directors. I've highlighted the area for you guys. It should enhance consistency, strengthen alignment with franchise owners, and give the company more control over execution across the system. The company said in the filing, and it also means, of course, a franchisor doesn't have to give up that 2% of sales. So the area directors normally made 2% of sales, and what they did was they helped to recruit people within their location to manage and own stores, well, manage and run locations within their area. They got 2% from those efforts, like we said, but they would have been the go-to persons. But with the regional vice presidents, they're going to be staff who is closer to corporate, and that's going to increase efficiency. The reason why this is important is because I remember at the start of the episode, I said to you that The growth strategy that you used to go from 1 to 100 locations is not going to be the same strategy that moves you from 100 to 3,000, and from 3,000 to 7,500, then 7,500 to 15,000. And this is where Jersey Mike's is. They're currently 3,300 locations. They want to get to 7,500 locations. And then on a global scale, 15,000 locations. The area director model would not help very much because it's going to be slow. It's definitely a cash strain because if you're giving them 2% of sales on your growing company, especially after an IPO, that's going to look very hefty on the balance sheet. And the proof of that is for the first quarter, on 122 million in revenue, the 10% increase. Like we said, they made a net loss of 24 million simply because they, well, in their own words, as they say, they paid 28 million in buyout of area directors. That's numbers, that's money that would have come due at some point in the future if those directors weren't bought out. And when the franchise is growing and looking to get on the public market, that is something that could strain the balance sheet. So those are 6 lessons so far. Let's get to the seventh lesson. The seventh lesson is a competitive advantage of patience, a very quick lesson in my opinion. If you are running a business, you have to be overly aggressive in the short term but very patient in the long term, which means that do not underestimate how much you can achieve in 1 year and don't overestimate how much you can achieve in 10 years. I think that's the saying that I think Bill Gates went with. Most people underestimate how much they can achieve in a year and overestimate how much they can achieve in 10 years. I think that's a code, or perhaps it's the antecedent. The idea here is that in entrepreneurship, things tend to go sour, things tend to go bad. We are very used to the glamour stories with tech unicorns, $7.5 billion valuation with no revenues, no profits, OpenAI, WeWork, for example. And sometimes they go up in flames. WeWork, sometimes they're hanging on by a thread, OpenAI, and sometimes things work out. What you need to understand is that your business is different, especially in the restaurant space. You do not want to rush and have things collapse under your feet because you don't have a solid foundation. 70 years, 20 years of consistent growth. Then they IPO'd 3,300 locations and they have a strong franchisee network of franchisees who are very excited to own more locations. That is the model that you want. Eighth lesson, and this is going to be very personal, same store sales matter more than store count. And this is especially true in the restaurant industry. It's not only about covering ground, you want to cover ground profitably. Because even if you have a restaurant like, let's say, Jersey Mike's or Subways, in each location that you go, it's a very different condition. And you also have to compete with the local chains where they have a brand and a personal connection with that area, that region, or that neighborhood when you go to those different locations, which means that not only do you want to be opening more locations, but more important than that, you want your locations to be profitable and continue to grow. Otherwise, they become a strain on your business. And this is why a lot of times you've seen, for example, I think Arby's, you've seen Arby's, Five Guys, you've seen that these companies, they expand aggressively. They go, they IPO, they raise funds, they open many locations, they sell many of their corporate locations to franchisees. And in the end, it doesn't work out because the moment things start to go by, what's the first move these restaurant chains do? They start to sell locations because those locations weren't profitable. And the reason why they sell those locations is because they're trying to trim the fat. They're trying to balance the books. They're trying to get their finances in order. You do not want that. It's better to grow slowly and profitably than accelerate and explode and then things fall under your feet because one's more risky than the other. And I prefer to less risk when I'm managing something as volatile and as shaky as a restaurant. Ninth lesson, which is absolutely amazing that we've been here all this time. If you're here even now, go ahead and leave a comment in the description. I'll be very excited to hear what you've learned so far. And you like ninth lesson. Ninth and final lesson, real quickly. Entrepreneurs obsess over valuation, investors obsess over cash flow. And this one is very simple. Like we've said, 6.3 billion purchase price a year ago. I think it was January 2025. This year they're looking for 7.6 billion in an IPO. But the reason why they were bought for 6.3 billion dollars, it's not because they have 3,300 locations. It's because they have 3,300 profitable locations. Otherwise, it would have been pennies on the dollars for that purchase. Otherwise, it would have been a rushed sale. Otherwise, the owners would have been under more pressure to sell, but they weren't. They had a very strong model. Not only is patience important, not only is having repeat customers, not only is your lifetime value of your customers important, but you also want to look at your cash flow. Cash flow positive. Even though they made a loss the first quarter of 2026, I believe, a $24 million loss on the quarter, actually, they still have very strong financials because revenues are up 10%. And store sales, they have the numbers here where they say that the store sales for this year so far, yes. So for the March 29 ended first quarter this year, same store sales were up 1.7%. And that is driven by transaction growth and a higher average check, which lapped a 4.9% increase a year ago, which tells us something that even though their store sales are increasing year on year, that is not nothing, guys. That is actually very important. And I want you guys to keep in mind that that is the crux of entrepreneurship: cash flow over hype, patience over rush, profitability over increasing debt that you cannot manage. And I know that this is nuanced advice, but for most businesses, this is what you want to do because you're not all, because we're not Wall Street. Wall Street has the capital to fund and take on a lot of debt, buy time, and accelerate growth. But as entrepreneurs, unless we have the Wall Street backed investment, even though Jersey Mike's has that with BlackRock, we want to make solid financial decisions. Thank you guys for tuning in for this episode. In the next episode, we're actually going to have to take a look at Xbox. Not just Xbox because they're increasing the price of the Xbox and we don't care about the game, we care about the business lesson behind it. We're also gonna have to take a look at gaming PCs, smartphones, tablets, all these gadgets that are increasing in price simply because of the chip shortages due to the AI hyperscalers and semiconductors. And we're going to have to break down all of that and try to understand what it means for the supply chain and what it means, especially for your business as an entrepreneur, and how you can use all those lessons to make more money for your business. Thank you guys for tuning in. You can check out that video right here. Hit subscribe. See you next week.